Now we look at budget control, but how we use the budget to control cost. Controlling cost is what management must do. We must control the cost of operations. And we do that by using the budget. We create what are called reports, budgeted reports, which compare what we actually did with what we planned or budgeted for. And in this way we get feedback, which tells us how well we are doing. Now previously we looked at how we develop a budget. Now we're looking at how we use the budget to control our costs, and we do that by analyzing the difference between the actual and the budget. And we then look if there's a big difference, we take action to correct it, and then we change our plans for the next year. We incorporate that new information. In management, we are always creating reports. Company works best when they have a formalized reporting system. And so we create a lot of reports. The reports identify the name of the budget report, the frequency, the purpose, and who is to get it. For example, here are some reports. This is a sales report. It's done weekly. And we compare the sales goals against what we actually are achieving. And this would go to top management and the sales manager. Scrap report. We do this daily. We look at how efficient we are using the materials, and that report goes to the production manager. The departmental overhead costs, they are reported on monthly. Here we are attempting, the purpose of it is to control overhead costs, and this goes to the department manager. And so you can see there's a number of reports that are produced on a monthly basis on every business. Now these reports are comparing actual against budgeted. We must keep in mind though that with the master budget, we call that a static budget because the master budget is built on a certain level of sales, and all the costs are compared to the cost at that level of sales. So that budget is called a static budget. It ignores data that it's okay if the level of activity we actually achieve is very close to the activity we predicted we were going to achieve. And in that way we can compare actual with budgeted. An example. For the sales budget for this Hayes company, the kitchen mate, second quarter 2007. Here we have sales, budgeted and actual. First quarter budgeted was 180 and the actual was 179, so the difference is 1,000. Second quarter, the budgeted was 210, the actual was 199.5. So you see we have a total difference here between the budget and the actual of 11,500. Now the way the report, this sales report for the end of the first quarter, would have the product line, the amount that we thought we were going to sell, the amount we actually sell, and now we indicate the difference. And the difference is simply what we actually sold versus the budget. And that's $1,000 difference. And because we sold less than we thought we were going to sell, we say that that variance is unfavorable, so we mark it with a U. Now in this case, we're only out 1,000 on a budget of 180, and that's not very significant. That's not worth management's time looking into why we're out by $1,000. Now in the second quarter, this is the second quarter, June, same product line, the budget is 210, the actual is 199.5. So the difference here is a huge difference. It's 10,500. And it's very unfavorable. 10,000 on 210. That means it's about 5% out. We call that difference material, which means we should investigate as to why we are out by such a large amount. And depending on the cost, we should then take what's called corrective action to fix the problem. Now, using the static budget material and comparing actual to the budgeted amount. It's okay if the activity level is very close to the master budget activity. So we can do that. But it also is okay if we're comparing fixed costs. You see, fixed costs do not change if sales changed. But if we are out and our sales are not more or less than our master budget, then the variable costs will be quite different. Not because we've been inefficient, but because we're comparing sales at the master level against the actual sales. And so in the next video, we're going to introduce what's called the flexible budget. And the flexible budget is what we use to analyze variable costs, because the static budget is not appropriate for variable costs.